Okay, let's be honest. The world feels a little bit crazy right now. You've got Donald Trump making threats toward Europe, Russia's ongoing war in Ukraine, China's ambitions, and right in the middle of all of it, the price of gold has just skyrocketed to all-time highs. So what's the deal? Is this a total panic buy, or is it actually a smart move? Let's break it down.
And when I say skyrocketed, I am not kidding. Since Donald Trump's election, the price has shot up 85%. That is dramatically outpacing traditional assets like stocks. I mean, that's a number that's pretty much impossible to ignore, right?
Which, of course, brings us to the million-dollar question. Or maybe the $3,000 an ounce question that's on every investor's mind. With prices this high, is this a smart, prudent investment, or are you just buying into the hype at the absolute peak? But you know what? Before we can even try to answer that, we have to reframe the whole conversation. Because the right move for you depends entirely on your reason for buying it in the first place. Are you worried about war, inflation, or are you maybe just trying to make a quick buck? Your why completely changes the answer.
So let's start with the biggest players in the game right now, central banks. Their recent buying frenzy is really the main thing driving this rally, and if you want to understand what's going on, you have to understand their motive. So the big trigger event happened back in 2022. When Russia invaded Ukraine, the West did something unprecedented. They froze Russia's foreign currency reserves. Now, this sent an absolute shockwave through the world's central banks. The message was crystal clear. If you hold your reserves in another country's currency, well, they can be taken away. The solution? Buy physical gold and stick it in your own vault. It's the one asset nobody can sanction away. Okay, so you're probably not a Russian oligarch worried about sanctions. But there's a really important lesson here for the average investor. With threats of punitive taxes on European investors or other kinds of capital controls, the idea of having all your assets tied to one single country's political whims, well, it seems increasingly risky. Gold offers a way to diversify away from that very specific political risk. All right, let's move on to the most common reason people give for buying gold: to protect against inflation. It's an idea that's been around forever. But is it actually true? Well, the answer isn't nearly as straightforward as you might think. So let's look at where this idea even comes from. Gold has some truly unique properties. For one, it's incredibly rare. It's also virtually indestructible. It doesn't rust or degrade. It's been a cultural icon for thousands of years. But most importantly, you can't just print more of it. A government can't devalue gold the way it can devalue its own currency. And this really illustrates the long-term case for gold. There's this famous example. Back in ancient Rome, 1 ounce of gold could buy you a pretty good cow. It was a recognized measure of significant value. Now, fast forward 2,000 years. A cow today costs, around $3,000? And guess what? That's also roughly the price of an ounce of gold. It's incredible. The purchasing power has stayed remarkably stable over millennia. So as a store of value over centuries, gold has proven to be incredibly effective. But here's the crucial question. Most of us aren't investing for the next 1,000 years, right? We care about protecting our savings from the inflation we're experiencing right now over the next 5, 10, maybe 20 years. And on that time scale, the picture looks very, very different. Just take the period from 1980 to 2000. This was a time of serious inflation in the US. The dollar lost more than half its purchasing power. So gold should have soared, right? Wrong. The price of gold also fell by more than half. In fact, when you adjust for inflation, a gold investor lost a staggering 80% of their money. So here's the key takeaway. As a short to medium-term inflation hedge, gold is completely unreliable. So if it's not really for inflation protection, what is gold's true role for a modern investor? Well, the best way to think about it is as a form of insurance. And I mean that in the most literal sense. Imagine living just a couple hundred kilometers from an active war zone. In a true catastrophe, we're talking war, revolution, societal collapse, your bank accounts might be completely inaccessible. This is a modern example of a timeless truth. Just think of families escaping Vietnam or post-war Europe, where a small amount of physical gold was the difference between starting over and having absolutely nothing. It is an insurance policy for survival. But this idea of insurance also applies in a less extreme, purely financial context. Think of it like homeowners insurance. You don't buy it expecting your house to burn down so you can get rich. Of course not. You buy it for protection if disaster strikes. Gold can play that same role in your portfolio. Here's how it works.
Historically, gold has what's called a low correlation to stocks and bonds. Now, that's just a fancy way of saying it often zigs when other assets zag. Because of this, adding a small allocation, and most experts suggest somewhere between 5 and 15%, can actually lower your portfolio's overall volatility and risk, even if it might slightly lower your expected long-term returns.
Okay, so we've covered the geopolitical angle, we've busted the inflation myth, and we've talked about the insurance case. So let's bring it all together into a final verdict for the smart investor. First, we have to be really honest about what gold is and what it isn't. It's a static chunk of metal. It sits in a vault and it does nothing. It produces no economic value. Your only hope for a profit is that someone else, down the line, will pay more for it than you did. Now, contrast that with stocks or real estate. These are productive assets where millions of people are working to generate profits or that are generating rental income. Those can make you money even if the price stays flat. And with prices at all-time highs, the question of whether to jump in is more pressing than ever. You have to remember 1980. Investors who piled in at the peak then had to wait 20 years just to break even, and that's not even counting inflation. Nobody knows where the price will go tomorrow. Treating gold as a speculative bet to get rich quick is a very, very dangerous game. So, if you do decide to buy, the how goes right back to that why we talked about at the beginning. If your goal is true worst-case scenario catastrophe insurance, then you need physical gold, coins or bars that you can actually hold. But if your goal is simple portfolio diversification, physical gold is kind of a hassle. An exchange-traded commodity, or ETC, which is the security that just tracks the price of gold, is a much simpler way to get that exposure right in your regular brokerage account.
Ultimately, it all comes down to this. Gold has a legitimate, if limited, role to play as a hedge against geopolitical risk and as a portfolio diversifier. But it is not a get-rich-quick scheme. So you have to ask yourself, are you building a thoughtful, long-term portfolio that's designed to last a lifetime, or are you just chasing the panic in today's headlines? Your answer to that question will tell you everything you need to know about gold.